If you hold software companies in your retirement portfolio, you're likely looking at positions bleeding double-digit percentages right now. But right before you give in to the panic and hit sell, give me 2 minutes to show you how to manage this crisis the right way. When we see the software stocks in our portfolio slashed by tens of percents and read headlines screaming that the software era is over and AI will replace everything, fear takes over. And then, most of us make one of two automatic mistakes. The first mistake: we rush to sell the stocks that still have a slight profit, just to save something. The second, and more dangerous mistake: we pour more money in and buy crashing stocks. But acting out of panic, or averaging down in an attempt to catch falling knives, that is not a strategy. That's the trap that will kill your retirement. So, what's the bottom line? How do you escape this trap? The solution starts with understanding one golden rule. A properly managed portfolio is never built as one big pile. It is divided into segments, with each segment having a different investment horizon and a different role. Let's look at the midterm segment of your portfolio. What is relevant right now are the market indicators, the volatility index, VIX, and the fear and greed index. When you combine these fear gauges with the fact that software stocks are currently in a clear downtrend, the cold conclusion is exactly this: it is simply incorrect to hold software stocks in your midterm segments. Now is the time to exit those holdings there. But, and here is the secret to proper management, in the long-term segments, the story is completely the opposite. That is exactly where you can consider initiating or even increasing exposure. How do you do it right? We cherry-pick only those companies that will present strong earnings and future growth forecasts, despite the AI disruption, as presented in their latest reports. Don't want to pick individual stocks? A simple and smart alternative is to build long-term exposure to this sector through an ETF like IGV. But when exactly do you pull the trigger? This is where we use the indicators for timing. When the VIX spikes above 30 and the fear and greed index drops below 20, that is your precise timing to open or increase that long-term exposure. That is what it means to manage your portfolio instead of letting fear manage you. If you want to stop guessing and start managing your retirement portfolio like a professional, hit the subscribe button. Here at The Proactive Pension Manager, we translate market noise into bottom-line actions. To learn exactly how to accelerate your retirement, click the video on your screen right now. I'll see you there.